The Reserve Bank of India has told banks that they need to change the way they calculate lending rates on floating rates for retail and SME borrowers. If until now, lending rates have typically been linked to some iteration of the cost of funds of a bank, now the RBI is telling banks that you have to link it to an external benchmark. That makes for a huge change. It has implications for the customer, for the banks, and also for the economy. We're going to call this the non-banker's guide to lending rates, and joining us to speak about that is Rajiv Anand of Axis Bank. We're hoping to get some answers from him. Rajiv, thanks for joining us. But before I come to you, I'm just going to briefly tell our viewers what the RBI has done. Firstly, this has been a long process of change that India has gone through. We've gone through various kinds of lending rates, the prime lending rate, the benchmark prime lending rate, the base rate, the marginal cost of fund lending rates, and finally now external benchmark linked rates. Rajiv, the basic difference seems to be that until now, most formulas were linked to the cost of funds of the bank, and now the RBI is saying that link it to an external benchmark. Is that fair to say?
Absolutely. The MCLR, I think it was earlier it was either the average cost of funds or when MCLR came in, the marginal cost of funds for a bank really determined what the rate of interest or what the MCLR should be, and therefore what should be charged to the borrower. And I think now there is a fundamental shift in that paradigm once again, where the RBI has now asked us to benchmark against an external benchmark, which is sort of easily available. Having said that, it is an external benchmark plus a bank's expectation of the credit quality of a particular customer, which is what the credit spread would be. So just to make it simple, so if the benchmark is 6% and the credit spread is, let us say, 250 basis points, the rate to the customer effectively is 8.5%, which is 6 plus 2.5. Having said that, if the 6 becomes 5, then the effective rate to the customer becomes 7.5, and if 6 becomes 7, the effective rate to the customer becomes 9.5. Having said that, what the RBI is also asking us to do is to ensure that we keep the 250 basis points static through the life of the loan. The only way that the 250 basis points spread could change is if there is an improvement in the quality of credit, or if there is a deterioration in the quality of credit, is only when that spread could change. Which means that if a customer's credit behavior is good, it is possible for the 250 in this particular example to become 225, or if there is deterioration in meaning that the customer delays a few AMIs but still is reasonably standard, then in which case the 250 could become 300 basis points as well. But in general, assuming all things remaining constant, the expectation is that 250 remains 250.
Okay, Rajiv, whole bunch of specific questions coming your way. Let me start with first just putting out the various benchmarks that the RBI has suggested that banks can use. It could be the repo rate, the 91-day treasury bill yield, the 182-day treasury bill yield, or any other benchmark fixed by the FBIL. Rajiv, explain to us whether one is preferable over the other, and also what will guide the choice of a bank between these benchmarks.
I think one of the key things, particularly for a retail customer, that one needs to recognize is that while on the one side we will certainly see greater levels of transparency because we are now using an external benchmark, it also means that there is greater level of volatility, and this greater level of volatility will come through because repo rates have changed, or sort of there is some tightness in the market, and 182-day T-bill rates have gone up or down, or the shape of the curve has in a sense changed, meaning that the short end has tightened, but we are going to see a long end rally. All these various permutations and combinations could drive change to the benchmark, which will in turn get passed on almost instantly to the customer, both positively and negatively, which means that transparency will come at the cost of volatility as far as customers are concerned. And an important point that I want to make here is that what tends to happen, and this is normal customer behavior, is that if my EMI is 100 rupees and that has now come down to 90, typically I would sort of spend that 10 rupees away. However, when the 100 rupees becomes 110 rupees, my salary or whatever still remains the same, and therefore it becomes a bit of a struggle to be able to fund that extra 10 rupees on a monthly basis. And what one would expect the retail customer to do is to be disciplined both on the way down, such that he's built some sort of a buffer for when interest rates do go up. But generally speaking, retail customers don't think in that manner. But now in this new environment, managing your cash flows is going to become more and more important.
No, 100%, Rajiv. Firstly, I assume that the choice of benchmark will be the banks, not the customers. Is that right?
Absolutely. So we're doing some work around, wearing the customer lens to ensure that the levels of volatility are minimal, but at the same time ensuring that return on equity for us, etc., still continue to be managed in the manner that we want it to be managed. We're doing some work around which is the most appropriate benchmarks to use, and we will come up with the appropriate one at some point in time.
Okay, Rajiv, one of the criticisms again on the benchmark is that all of these are far more shorter term in nature than, say, a housing loan, because I think it's the housing loan portfolio that will get most impacted. Could customers see a scenario where different banks choose different benchmarks? But even if that happens, I guess the comparison is easier, right? You can compare the spread across different banks. You can compare the benchmark, decide which one works best for you. You can take an interest rate call and potentially pick the best option for you.
Easier said than done, Neera.
Yes, I know.
I think the risks is really the point that you make, that for a home loan, different banks could use different benchmarks. Different banks could assess you from a credit perspective differently, and so therefore how are you going to put all that on a spreadsheet and try and figure out what is the best for you, because a particular bank may give you a absolute rate which is lower today, but could also mean that you will see higher levels of volatility as you go forward. And so therefore, how are you going to assess the benefits or otherwise at the short term and versus volatility that could come in the long term? The other important point also is that the way that it currently reads is that this benchmarking is only applicable to banks. I do hope that as we go forward, as you think about the customer, you don't want to be in a situation where not only do you have multiple benchmarks from multiple banks, but a completely different way of calculation of rates through the NBFC sector, for example. And so therefore, making a informed call or making that choice between multiple banks and the NBFCs at any point in time is certainly going to get more complicated, and I think we certainly need to sort of work through this to make it as simple as possible for the customer.
Okay, yes, Rajiv, that clarity is required as to whether NBFCs come in it. They should. While you were talking, we had this sort of matrix of what's good for the customer, what's bad. The last thing that was pointed out, you've already spoken of a bunch of things, was that eventually you could see volatility in deposit rates. I think people have spoken about floating rate deposits. So the RBI doesn't prevent that, right? You can still offer that, but nobody does. Is that a possibility that will start to happen more?
Yes, there's nothing to stop banks from offering floating rate deposits. I think traditionally customers have been used to a fixed rate fixed deposit, but as banks look to to manage the basis risk that they are now going to be carrying on their asset side of the book, it becomes important for banks to be able to create liabilities with the same basis as well, but I don't think that's going to be easy. To tell retail customers that now we're going to offer you a 6-month deposit or 1-year deposit, which is going to be benchmarked against the repo rate or the 182 T-bill rate. Ultimately, what the customers, particularly on fixed deposits, is looking for is predictability. Today, he knows that if he puts money in a 1-year fixed deposit, he's going to get 7.5% or 8% or whatever it is. That predictability is what makes the fixed deposit product so simple and attractive. As you start to build complexity in terms of the pricing, it is going to be difficult.
Okay.
But banks will have to start raising money on the same basis as the asset side. Otherwise, the mismatch could potentially hurt.
Okay, that allows me to shift to the banking side. So from what we've gathered so far, what does this mean for banks? Probably, more negative than positive, although I've bucketed better liability management in the good, in the sense that it's good for the system over a longer period of time, but it'll be tougher liability management. And I think everyone believes that margins will become more volatile. Rajiv, is that the case? Because your margins, as somebody pointed out to me on Twitter, are now being determined by an external sort of factor rather than your own internal management.
Difficult to say at this point, Tira. I mean, if you look at margins, for banks, through that entire alphabet soup that you mentioned, BPLR, base rate, MCLR, etc. Margins have held up, quite nicely through this phase. So I think we'll have to wait and see on what happens to margins.
Okay, but you would have to, say, manage interest rate risk on your liability portfolio a lot more actively. The instruments are available to do stuff like that, Rajiv?
Like I said, I mean, I think the the one thing that we will certainly have to do is to start to think about market-linked deposit products. What you also could see, is, remember that these are these new regulations or guidelines are relevant only to floating rate products. So perhaps, and therefore, in that sense, the most relevant is for sort of home loans and working capital loans for MSMEs, etc. So you could see sort of innovation and structuring in such a manner that we do more fixed rate loans to make life simpler, for the customer as well.
Sorry, this is a slightly dumb question, Rajiv, but do banks which have higher CASA have a little bit, will they have it a little bit tougher in managing this risk that will come in? I'm asking because then, you have a smaller proportion of your deposit base available to manage interest rate risk on, assuming that you don't want to move on your, large CASA interest rates.
I think ultimately the larger base of low-cost deposits, the better it is for you. I don't think that changes anytime soon.
Okay, let me just get a sense of, so it's largely from the retail end, home loans that get impacted, and then it makes it even more important for HFCs to be brought into the same sort of ambit, or is the competitive pressure so large in these in this particular category that eventually rates will be pretty similar across the board?
See, I think, let's leave the competitive pressure out for a moment. All I'm saying is from a customer perspective, as he compares, when he buys a loan and he wants, when he buys a house and he wants a home loan, and as he looks across the multiple providers of loans, the comparison should be, simple and easy to use, rather than, multiple benchmarks across multiple banks and a completely different way of looking at it as far as NBFCs are concerned. I think it's just a function of level playing field and simplicity and transparency, which is really what the RBI is looking for from a customer perspective.
Okay, last few questions, Rajiv. Old versus new, this would have to be applicable only to new, I presume. But would there be some way to make sure that old and new is not entirely disconnected? Or will, say, for a charge, banks allow customers to switch between, say, MCLR and the new rate, the same way you had done between base and MCLR?
So I think the way it currently reads is that all new loans from 1st April onwards will be on this new regime. We'll have to just figure out when the detailed guidelines come through in terms of what exactly happens to old loans as well. But if you've noticed between as the transition from base rate to MCLR happened, customers had a choice of moving from base rate to MCLR, and I think it perhaps could be a similar structure in the new environment as well.
Last point, and we'll put this up on the screen. What does this mean for the broader sort of economy? I think it will probably or hopefully help solve that age-old problem of poor monetary transmission. That is extremely important to the central bank, and in many ways, actually in all ways, that is what guided this change. So people are hoping that there will be stronger monetary transmission, at least on that one pool of loans. Better credit behavior, as Rajiv was pointing out. Customers have to now be a lot more careful about their credit quality, because if their credit quality slips, automatically perhaps your spread will increase. And from the bank's end, it will probably mean improved liquidity and risk management. So it seems like broadly all good for the economy. Rajiv, would you concur with that, that if this doesn't help monetary transmission, I'm not sure what will now?
No, I think that was well articulated. I think if you look at it from the RBI customer and bank's perspective, I do agree.
All right, Rajiv. Thanks so much for taking all of our questions on this new formula for lending rates, which will come into place starting the 1st of April. Still, a lot of details are awaited from the RBI, but the announcement that we are transiting there has now come. Thanks for watching Bloomberg Quint.